Welcome to the latest in our series of bank management interviews. Today we have with us Scott Sandlin, Chief Strategy Officer from White River Bankshares. White River is located in the northwest corner of Arkansas, think Bentonville and Walmart, with some additional locations in the eastern part of the state. The White River story checks off the key boxes investors look for. It has a strong deposit franchise with some size, about 780 million in deposits, with 34% of that being non-interest bearing. It has a growth story to tell. They've been able to maintain a very clean credit profile, and the management team is highly regarded with interesting ties to Walmart. And finally, from a valuation standpoint, WRIV is trading around tangible book value, and we're going to get into talking about the AOCI write-down. If you could think about that, it's trading at less than tangible. So I'd like to turn it over now to Julian Casarino, and we can start the Q&A session.
Okay, great. Well, Scott, again, thank you for joining us. Since we talked with you about a year ago at our online conference, a lot has changed. You've made some big investments in the Latino sector in treasury management, digital products. Maybe you can talk about some of those investments and what kind of return and the timing for break even on those investments. If it's within a year, within 3 years, we'll have the time frame.
Thank you very much, Julianne. I'm really glad to be here and glad to share our story with you. So late last year, as we go through our strategic planning cycle, we typically start the strategic planning cycle around April, and then we kind of walk it through the summer, and then we get into the fall and actually have the board approve it. But as we were going through our strategic planning last year, there were three big things that kind of came out of that session that I want to talk about and share with the group. First of all, we felt compelled to really look at our core platform. And so from a core business perspective and our core technology platform, we did not believe that the provider that we were using at the time was going to be able to take us to where we want to go in the future. And we're very proud that we went through that selection. It took us about a year to make that choice, and we actually converted in October of last year, and we have a new core provider that provides us the ability to really do the digital things that we're going to want to do in the future. It obviously has the ability to link into new technologies, whether it be fintech or other areas, very user-friendly, improves our internet and our website. It also helps with our phone and phone optimization, our digital optimization on cell phones. So it moves us in a position to be better to serve our customers into the future. So that was one big investment that we went through. We also got a little bit ahead as it relates to our key talent. And so we decided strategically that we would pick the top 20 people in our organization and really evaluate their income and their overall compensation package. And I'm proud to tell you that we made some significant adjustments for some people that ironically, as we got into the first quarter of the year, we've all seen, with the Great Resignation, a lot of poaching and a lot of top talent being acquired from other organizations. And so we felt like we got ahead of that and did a nice job to make sure that we protected our resources and assets and pay our people appropriately so that they're well positioned to help grow the organization, since we're on a growth strategy. Last year we had we started with 2 new markets, and we'll add our third this year. So technically we brought on Harrison, which is in the middle part of the country. For those people who don't know our area very well, if you've ever heard of Branson, Missouri, it sits about 30 minutes south of Branson, kind of in the middle north central part of the state, with a very large tourism business, a very large recreational business. A lot of people don't realize that FedEx ground headquarters is in Harrison. So there's a very big FedEx relationship, and there's also a nice junior college over there that's done quite well. It's more of a manufacturing town, but it's an area that we've had our eye on for quite some time, and we were able to get some very strong bankers to agree to join us from over there, and we feel like we can replicate what we do here in Northwest Arkansas over there. We also had the opportunity to look at last year and bring on Jonesboro, Arkansas. So if you know the state at all, that's over on the east side of the state. Sits about an hour to the northwest of Memphis. There's been significant growth in that part of the state as it relates to college, as it relates to healthcare. And more specifically, there's been a lot of investment in the steel industry. So Nucor Steel has made a $3 billion investment in that area. There's also some other steel manufacturing that's going on over there. So it's a very good industrial economic center for the state. So what's happened to Signature Bank in the course of the last year since we talked is we've gone from Northwest Arkansas to really North Arkansas. So we support all of North Arkansas, north of the Arkansas River. And so with our Brinkley location that you mentioned earlier, that's kind of also central in the state, that's kind of our area of service. So we've focused on that. But the crown jewel, so to speak, of one of our initiatives that we're very proud of, and we're getting ready to we've actually announced the name, and we're in the process of getting all the building and everything in place so that we can open a little later this summer, is we looked at the census of Northwest Arkansas. And when we found out that we have 114,000 people of 643,000 that are Hispanic, we felt like we were missing a huge segment of the population. And so we put our heads together and we thought about it long and hard. And because of some of my former Walmart relationships and some of the people that I worked with, I partnered up with a very good friend of mine and started challenging on what we needed to do differently. And so we are going to open later this summer a division of our bank called Banco C. So very proud of that name. It's going to be a full-on, totally Hispanic bank. And what I mean by that is everyone that works in that location will speak Spanish as well as English. They have an advisory board that's comprised of a lot of very influential CPG business owner Hispanics from the area that we've gone and comprised. There's about 20 of them that work at Walmart, work at Tyson, work at Procter and Gamble, JB Hunt, Simmons Foods, all of the big manufacturing and CPG companies here in Northwest Arkansas have some, if not quite a few, Hispanics working on their teams, and we've enlisted their help to help us with this initiative. I don't want it to sound as though it's like its own standalone. It is certainly a standalone business that's separate, serving the Hispanic market, but we have taken the learnings from what we've already learned from the advisory board, and we're implementing those in all of our locations. Because as you look at North Arkansas is represented by 18.7% Hispanic population throughout all of North Arkansas. So we have a lot to learn. We have a customer set to serve in a new market. And as we grow, and we'll continue to look at our growth, we're excited about the future and really learning more about some of the people that live in our area and serving this local community.
Okay, so just to follow up on some significant investments, your FTEs went from, I think, around 154 last quarter to 175 in the most recent quarter, I should say. So a big increase in the new year in 2022. And we see the higher comp expenses that you alluded to. What kind of earn back, or what kind of break even? When should we see these investments being break even?
So we put them on a on a payback of 18 months to 3 years. So we kind of set it up so that we're working on that kind of a payback timeline. I'm proud to tell you that I think some of them are going to come much faster. You alluded to this earlier about our deposit franchise. 5 years ago, we weren't a deposit franchise. This bank basically took an initiative to make sure that we were going to really become a deposit franchise. We worked very hard with all of our lenders and all of our retail bankers to make sure that that was a focus for us. We made a big investment in the treasury services that you alluded to earlier, and it became a focus. And now today we are a deposit franchise, and we will continue to work on building our deposit relationships, because in order to be a true bank in today's world, you have to have deposits as well as making loans. You can't just be a one-sided bank, or things get difficult.
Right. Scott, where are we in terms of the investment timing? Is there more investment to come in the near term, or has it largely been done by this point? And
yeah, at this particular point in time, I would tell you that we're kind of at the tail end of the investment, and then we are going to, be working very hard to bring those those 3 new markets online, as you talked about and alluded to on the head count. Most of our hiring has been done.
okay.
We have completed most of that. We have a few more here and there to bring on, and as we've had a little bit of turnover, we obviously would replace any positions that we have as it relates to turnover. But we're very fortunate in the fact that we just have really been able to keep a solid work group in place, and right now our primary focus is to go deliver return on investment. So that's going to be the quest for the next, we'll call it 1 year to 18 months,
to show higher profitability now that the investment's been made. Okay, so that 18 to 36 month period has already started. That started first quarter, right? Okay, so we're on the payback clock.
We're on the payback clock. That is exactly
all right.
right.
Very good.
And so we have each of those locations came on, I'll say about 6 months apart.
Okay.
So that we can actually start to see some of them pay back earlier than others. The good news is some of those locations have actually outperformed even our estimates. And the idea is to, spend time and effort in bringing them up and getting them to where we need them to be.
Okay. Well, talk about payback or earn back. And why don't you ask about the AOCI?
Yeah, great. Thanks, Scott. Thanks, Joanne. So there was like most banks in this previous quarter, with interest rates moving up, took a hit to their valuation on their securities portfolio. I think some investors that I talked with about White River seemed to, it was a big number in dollar amounts, because your book value is, high, it's a bigger number. So it was about, on a percentage basis, about 4.5% or so hit to tangible book. Where do you see those markdowns? Of course, it has to do a lot with where interest rates go, but most of a good part of your book is munis, not mortgage backs. So can you give us a little bit of insight into how those valuations may be looking forward?
Yeah, I mean, like everything right now, I think we're all watching everything that the economists are doing in the country, and there's some things that defy gravity, so to speak, on some of the investments that are out there. But it's just like yesterday, we sat with the Darling Group and listened to their chief economist go through and give us an analysis of where they feel like things are going and what's going on. We're staying very close to trying to understand, what true interest rates are going to do and what that's going to mean from a stress test perspective. I would tell you that, we have worked very hard to come out of those investments and be more in the low cost deposit investment side. We have worked, Brent, our chief operating officer, and Ed, our chief financial officer, have worked very, very hard to reduce our dependence on those outside vehicles. You're right. We do have some, we are picking up some bonds here and there, looking at some local school districts and some local things to pick up here and there to kind of hedge against that. We've looked, very closely. If you'll remember back in November a year ago, we took on a little sub debt. We also bought some sub debt. So that's we're looking at our capital very closely and trying to manage the specifics of that to ensure that we do everything we can to hedge the investment, so to speak, to help the bank's profitability. The other thing is net interest margin. We continue to work hard on that number, and cost of funds. We try to get that number as low as we possibly can, and we've made great progress there. So we feel like we're strategically positioned to perform in whatever market that we're served up. I think that we're all kind of curious as to what is the Fed going to do as it relates to interest rates. We feel like that obviously you're looking at some increase in the amount that we're going to be charging going forward on some of the loan portfolio that we have. So there might be a little bit of a pickup there. But honestly, from our perspective, we don't see like a rapid change in that. I think it's something that comes over time, a quarter here, quarter there, maybe a half to 3/4 by the end of the year. But that would be me just basically predicting what I'm hearing from the other economists. And we're all kind of very curious as to what is going to happen.
Yeah, I'm not sure if you know, or I was kind of wondering, and Julian as well, what the how the regulators look at the other comprehensive income write-downs. Do they take that into account for your tangible equity and so forth?
It's been a while, and we, obviously we talk to our regulators on a regular basis, but I don't know that that's really been a lot of what we've talked about. I mean, we know it was a hit. I mean, clearly we were rising in tangible book, but we feel pretty confident that you'll remember back just a few years ago, we were trading significantly below tangible book. And we actually at one point were trading a little bit above tangible book, but we're right there kind of about where tangible book is. So our trading value is about, just slightly off of tangible book, but very close.
Okay, thanks.
All right, so just about the AOCI mark, what is the duration of the portfolio?
That's probably a better question for Brant
Okay.
in the group than it is for me. And so I would need to go get that answer to you.
Okay, that's all right. We can, but and Ian and I were wondering if, because it does have more munis, if maybe it's not extending as much as like a more heavy mortgage-backed security portfolio. But okay, just to talk about the capital management. Thank you for the dividend, the dividend back in August. Really appreciated it. Maybe you can talk about the decision to pay that and how we can think about that going forward. If it's an annual, quarterly, semi-annual, and I'm assuming you decided on a dividend instead of share repurchases, or maybe you considered both, or maybe just talk about the potential for buyback, especially with the stock at tangible book.
Absolutely. So very proud to offer the first dividend last year. I would tell you that is something that we have basically baked into the way we're going to do business going forward. You'll remember that we started the bank about 16 years ago, had never paid a dividend, with always the desire to do so, and we were able to start that last year. We're in the process of preparing that for the board as we speak. to get their approval on the one that we're going to do this year. It will be an annual dividend that we do offer. We built it when we talked about it to the board. We talked about the idea of paying a dividend, and we kicked around, did we do, like a lot of other people do, a quarterly dividend or an annual dividend or semi-annual? And the board basically decided to start with the idea of an annual dividend, and then we would expand that as necessary over time, and we're able to do so. So that's where we started. We also have been paying very close attention through COVID and through, you know, the recovery from COVID, you know, at what some of the other organizations, big companies, have done. And so we want to make sure that we appropriately reward our shareholders for being good shareholders. And so I'm proud that we're on that path.
Great. Well, I appreciate it. Thank you. So an annual dividend, and with the amount being stated, you know, it's not like, it wasn't a special that, I mean, it's a stated 50 cents a year. Is that right?
That's what was stated last year.
Okay. So each year could be different.
That is correct.
Oh, okay. And so is it based on kind of a payout ratio range, or?
Well, and then that's what I was alluding to with studying some of what some of the other companies are doing. I think that we're going to, you know, we're going to head in a direction of creating we'll call it a floor or a base that we're going to give every year. And then some of the learnings that I have, and this is obviously things that I have to get passed through the board, but I believe that there should be some sort of a performance part of that. So based on the performance of the bank, based on the performance of the stock, I think some part of our dividend annually should be decided based on our performance. So would be kind of a hybrid compared to what you may be aware of in some of the other dividend models. And I think, you know, COVID kind of helped us all realize that, you know, you need to be very mindful of how you do these things financially. Right. We watched 34 companies that were blue chip Dow Jones companies that restated their dividend process through COVID. So I think that you know, my mindset is that we should be paying based on performance. You should always get something. You should count on something. That's why you buy stock. But to continue to increase and increase and increase, and then have something like COVID come along and then, you know, really hurt your company, are things that you should consider. So I believe, and like I said, this is, you know, we need to make sure that we get this this new model kind of developed, and it's in, you know, I'm talking about something that we don't necessarily have all the way done yet, but that's where I think we're headed.
Okay. All right. And what about share repurchases as a capital management option? Again, with the stock trading at tangible book, if not a little bit below. I know you, I just was curious. I know you have never been big buyers of the stock before, but you haven't paid a dividend before either. So I was just wondering, must have come up in conversation.
Yeah, 2 years ago, we initiated the stock repurchase program. We did buy stock a few times that first year. As was described to me, if you can buy $1 for less than $1, you should buy all the dollars you can. So we started down that process. I would tell you that we still have a stock repurchase program in place.
Oh, okay.
It is something we revisit. We paused it during the COVID timeframe, but it is one of the pieces that we have used as an idea to, you know, increase our overall stock value. So I would tell you that I don't know that will come out of pause anytime soon. I know that we're doing a little bit of purchasing on some fractional shares that were issued to try to clean up our book. But you know, right now that is not in play, but we do have it. I mean, it is part of our process that we just discuss in the board.
Okay. So what's the amount that's left on that authorization? Do you happen to know? Top of your head, or?
Yeah, I think that there's about 4% on that authorization still left.
Okay, so
it's pretty good. It's a pretty good amount.
All right. So here's what I would urge you to consider. You know, as you mentioned, you took a fresh look at the comp structure. for employees, particularly the higher compensated employees. And to the extent that stock is a portion of that, I urge you to at least use the buyback authorization to offset any stock compensation, increase, and so that the share count isn't going up, particularly again with the stock trading where it is. So that might be a reason to dust it off and bring it out.
Thank you. Yes.
Hit the reset button. So, okay. Well, yeah, thank you for thinking of it. Okay. Did you want to talk about the construction?
Yeah. It looks like approximately 18% or so is construction and development loans as part of your loan book. And of course, with interest rates rising, economy slowing, questions about the housing market. We just wanted to get your take on what's going on in your area and what's going on within your loan book. I think about 50-50 residential to construction in development and land. And just also, if you could, maybe you have some sense of what's pre-sold already, what might you get stuck with?
Yeah, believe it or not, and this is going to sound crazy, every bit of it's pre-sold.
Okay.
And let me just give you a little bit of a backdrop of Northwest Arkansas, and really North Arkansas for that matter. We talked about Walmart a little bit. I think some people might know this, maybe not everyone. Walmart is in the process of building a brand new home office. They're spending somewhere in the neighborhood of $3 to $4 billion to build that home office. The Northwest Arkansas area is, from a growth perspective, has three main verticals that are driving the growth. So you have the Walmart and all suppliers that are moving to the area. You have the arts corridor that is literally set up here, where you have Crystal Bridges, and there's now 3 other museums that have moved to town. And so there's a significant amount of museums that are here. And then we have an unbelievable investment and commitment from the Walton family, the Tyson family with Tyson's Foods, JB Hunt with John L. Hunt, JB's wife, on developing a medical corridor. So we have a relationship with Cleveland Clinic. We have a relationship with Mayo Clinic that are all basically bringing in new medical. We have Children's Miracle Network Hospital that's just opened up here. There's been a significant amount of growth in the medical corridor all along 49, which, and there was just an announcement the other day that Alice Walton, Sam's daughter, has agreed to partner with Whole Health and Washington Regional to create a training hospital for doctors and nurses and all of that here as well. So we feel very fortunate. And then one thing I didn't mention from an economy that is also a strong driver in Fayetteville is the college. And the University of Arkansas's growth has exploded. It's a major university that's respected in multiple areas. From a business college, they're ranked in the top 20 business colleges in the United States. They're #1 in supply chain management in the country. They have a very strong agricultural college, and they also have a wonderful engineering and IT college as well. So there's a significant amount of growth here. And then across all of North Arkansas, you heard me talk about industry, and you heard me talk about medical and universities. So it's all consistent really from east to west. All of that is pretty much the same with the economy. How do I feel about it with interest rates rising? I would tell you that right now, most of the homes that are being built are pre-sold. They're days on the market. We have a competitive situation where when you place a home on the market, you'll end up having 3 or 4 people that will bid it and pay for more than what is the price is being asked, which is pretty interesting. Now, will that slow? I think as a national average, we've seen, mortgages and secondary mortgages start to come down a little bit, but they were obviously at their historical highs. I would tell you that there's, I don't know that our area is going to see the national average as it relates to that. I feel very bullish on what's happening because of the growth with the industry. I think I saw the other day there are 10,000 job openings posted in Northwest Arkansas. We have people that are moving here from all over everywhere. The Walton children and grandchildren are trying to figure out how to make this new Walmart campus in the arts corridor something that people want to come see and be a part of. So I feel very good that we're in a position where if there is a downturn in the economy, it will be less felt here, and the recovery will be faster here, just like it was the last time it happened.
Given sort of while you are bullish about your area and there's some nuances there, from your credit quality standpoint, from your underwriting standpoint, have you tightened up things? Is there sort of loan to value boundaries that you won't cross on the C&D side?
Absolutely. And what I would tell you there is from the learnings of the last downturn in the economy, we do not, there's some things that we don't do. We don't typically lend money to people who are just building a spec house. We have builders that have come through the tough times with us, that we've stayed with, helped each other out. They've come out very, very well. And those are the people who we do business with. There's, we don't typically like to lend money for very large homes. So if you're going to build $1 million home, we're probably not the place you want to come, because we just don't do those. They're very hard to recover your money if things go bad on those kinds of deals. So we are very mindful. We created a team of people who actually go physically go to all of our construction sites, and before we release the productivity and the process, and the subcontractors are talked to, and we validate that those things are being done and built in the way that is truly business minded. So to answer your question on the have we scaled back? I would tell you we've been very mindful of the things that we learned from the downturn, and we're working very hard not to repeat any of the mistakes that were made from the last time.
Okay.
Great. And I think last time we spoke to you, you had an emphasis on taking those construction loans and converting them to permanent loans. I don't know if there's anything more to mention about that, but it seems that was an emphasis. I assume it still is.
It absolutely still is. And that those are, the good news is we have a team of people. We have a mortgage department here that can take you secondary, or we can do it in-house. And the idea is that when you come to us and we start, or if we're working with a builder who's building 100 homes, we work to try to create, a vehicle in a way that those are basically taken care of and brought all in-house or taken out secondary. So that is a focus and will remain a focus.
Great, thanks.
Okay, and so just to reiterate, of even the non-residential construction, whether it's land or commercial, it's all been pre-sold.
Yes.
Okay, great. And then just to finish up, because you're OTC,
just one follow-up question. Are you seeing, even though they're pre-sold, are you seeing any people backing out?
No.
Because I have heard that that's been happening in some construction situations.
We have not seen anyone back out of any of like I said, the thing that's been very unique in this market, and I personally just had a house that I've owned for 18 years that I had been renting, just to give you an example. And I put it on the market. I went in and did some, a little refresh, if you will. So I had some people go in and repaint it and change the carpet, and we put some new countertops and new appliances in there, and it was on the market for 6 days. And when it sold for more than I was asking for, and had 6 bidders.
all right.
And this is an 18-year-old home in a fairly established neighborhood, and I was totally amazed at the price that we got for it. there's just not any inventory here. And that's the, obviously I think, some things will catch up in the downturn, but there's just to kind of give you the Bentonville area where Walmart's headquartered, the price per square foot has just, it's unbelievable how it's changed in just really 3 or 4 years.
So it's kind of been a hot market, and I mean, it has been, it sounds like, with some meaningful price appreciation. And
It has.
right. Okay.
All right.
Okay, well, just to finish up, Scott, because OTC, because trades on the OTC, the ownership isn't always readily apparent. Can you just talk briefly about the insider ownership, the level of insider ownership, and also if there are any owners who own over 4.9%, collectively, any kind of concentration ownership?
Yes, there is. So thank you for the question. I would tell you that there, if you'll remember back when we first listed on the OTC, I would tell you we had probably 30 to 35% were institutional investors, and the institutional investors now have actually, as you would expect, they were on a timetable, and they've converted their timetable. Through that process, we now have sitting around the board table and in the executive team a representation of about 30%. So 30% sits around the table. Most of the investment is all local investment. When I say local investment, it's people who know us, people who've invested in our bank. We're very fortunate to have, as you heard me talk about, some very wealthy people that live in Northwest Arkansas that are very interested in participating in being part of the bank and have been for quite some time. We obviously are always looking for new good investors, but the big investors that we originally took on, both of them have basically sold their investment and made a very nice income and increase from that. So I'm proud to say that's a stock that you buy and you actually see some appreciation.
And the stock has held up very well in this past year. It's done heroically. So are you saying that the board of directors owns around 30 to 35% of the outstanding stock?
So it's the board and the management team collectively.
Okay, board and that's including families.
That is correct.
That's so 30, 35% owned, okay, by board and management, with the balance largely being owned by local investors.
That's correct.
Okay, and does any individual or any family or whatever own 5% or more?
Yes, we have about six people that qualify for that.
Okay, and they're on the board, I'm assuming.
They are.
Okay. Okay, and no other institutional investors, or because I don't think they have to report their ownership.
No, we do have some institutional investors. I think the number of institutional investors now is also somewhere in the 5 or 6 range. And what I would tell you is I'm very proud that with the ones that we have, they're quite active and give us great guidance and great advice. Which it's a pleasure to have those, and we were fortunate in the fact that when we first took on institutional investors, we had people that were willing to share with us learnings from other banks, and that's how we've come to partner with some of the people that we're partnered with that have helped us a lot.
Okay, great.
Well, terrific.
Thank you.
Thanks so much for sitting down with us.
Yeah, and for bringing us up to speed again. It's been quite an eventful year, and thank you. Yeah, thank you for taking time to talk with us.